Let's talk about how vectors apply in the world of finance. We'll start with what a vector is, something with both magnitude and direction. Then, we'll explore how vectors help organize financial data, from stock prices to portfolio weights. Finally, we'll walk through a simple example to see how vectors drive smarter financial decisions. Let's break down vectors, from physics to finance, and why they're more powerful than you think. What is a vector? A vector is a quantity that has both magnitude and direction. Think of it as a fancy arrow in space. How vectors are represented. You can write a vector using its components. In 2D, it's like 3, 4. In 3D, something like 2, minus 1, 5. Vectors come in many types: zero vectors, unit vectors, equal or opposite vectors, and even those that lie in the same line or plane. In finance, vectors are everywhere: price history, features in AI models, asset weights in portfolios, and more. First up, a time series vector. It stores the price of a stock across time. Super useful for trend analysis. Feature vectors describe a trade, and weight vectors show how much money goes into each stock. On the left, the image illustrates a feature vector with values such as price equals 150.5 and volume equals 10,000. On the right, it displays a portfolio pie chart representing asset allocations of 40%, 35%, and 25% across 3 investments. Position vectors track what you're holding. Return vectors show what you're gaining or losing. In this image, we start with the position vector, 100, minus 50, 200. That means we're long 100 shares of asset A, short 50 shares of asset B, and long 200 shares of asset C. Next, we look at the return vector. 0.01, minus 0.005, 0.02. In machine learning, gradient vectors help us update models to get smarter with every step. In this image, we start with the original model weights, 0.5, 0.3, 0.7. Next, we apply the gradient vector, denoted as nabla W equals minus 0.04, 0.1. Let's walk through a simple trading strategy using vectors. We begin with the price vector, 100, 102, 101, 103, 98. These are the stock prices over 5 days. Next, we calculate the mean, or average price. Mu equals 100.8. Then, we find the deviation vector by subtracting the mean from each price. That gives us minus 0.8, 1.2, 0.2, 2.2, minus 2.8. Now comes the decision step. If the deviation is greater than a certain threshold, we sell. If it's much lower, we buy. Just like that, the model uses vector math to guide trading decisions, clean, fast, and loop-free. The whole strategy works with simple vector operations, no loops required. From rocket science to the stock market, vectors are the unsung heroes of modern data. Use them wisely.